In today's session, we would be learning adjustments which are associated with the preparation of final accounts. So we would have to be learning quite a few adjustments. Uh, but before we learn how to go about with the treatment of some of these adjustments, let us try and understand what is meant by the term adjustment. Okay, what is meant by the term adjustment? Adjustments are transactions that are identified by the accountant after the preparation of final trial balance. Please remember, the prerequisite for the preparation of final accounts is the trial balance. What is trial balance? Trial balance is said to be the summary of all the ledger accounts in a business, or all the ledger accounts in the business. If you take that together and then prepare a one-page summary, or prepare a one-place summary, that is referred to as the trial balance. So adjustments are transactions which the accountant for some reason missed out while incorporating during the preparation of trial balance, and these transactions have been reflected later, and that's the reason why we are having these adjustments. Now, please remember, these are transactions that has been missed out during the preparation of trial balance. So for us to prepare the trial balance, you have to remember the accounting process. You start off with recording, then you classify, then you summarize the transactions. So if you are coming across some transactions that were not included, that was not incorporated into your bookkeeping process, then please remember, it has missed out the recording phase, it has missed out the classifying phase, and you have to incorporate this now in your transactions. Now, why are we incorporating this in your transactions? Else, our accounting structure or accounting framework will not be complete. These transactions will be outside the accounting framework. That's the reason why we have now decided to incorporate, or we have decided to include these transactions as well. So because these transactions were missed out for some genuine reason, it has not been incorporated into your preparation of your trial balance, which means it has skipped that step on recording, it has skipped that step on classifying. Okay, it has skipped that step of recording, it has also now skipped the step of classifying. Now that you have come across these transactions, it is the accountant's responsibility to incorporate these transactions into the trial balance. Okay? So because these transactions were missed out, it has not gone through the conventional accounting process, that process of recording and then classifying. So which means these transactions were missed out when you have prepared your journals, when you have prepared your ledgers. Had you incorporated these transactions, then automatically these transactions would have been reflecting in the balance of your trial balance. But that has not been done, that has not carried out, or that has not happened. Now, because these transactions have been identified after the preparation of the trial balance, you will have to treat these transactions twice. Now, why are we treating these transactions twice? Please remember, according to the dual concept of accounting, every transaction has got two effects. It has got a debit effect, it has got a credit effect. Because these transactions have not gone through the conventional accounting process, both the effects may not have been incorporated. Both these effects have not been incorporated into your books of accounts. That's the reason why you are treating these transactions twice. So according to the dual concept, every transaction has got two effects. Both these effects have not been incorporated into while you were preparing a trial balance. Now that you have identified these transactions, you must incorporate them into your accounting process. That's the reason why you're treating them twice. Okay? That is the reason why you're treating them twice. So this may be the reason why your accounting teachers earlier, they kept insisting on the fact that whenever you come across adjustments, you will have to treat it twice. The rationale, the logic behind that statement is this, because it has got two effects. Every transaction has got two effects. It has got a debit effect, it has got a credit effect. Both these effects have to be incorporated, both these effects have to be brought in. That's the reason why they have been asking you to treat it twice. Now, what are the possible combinations for treating these? Okay, what are the possible combinations for treating this? One is trading account and balance sheet. Okay, so one possible combination is whenever you come across adjustments, you will have to either treat it in your trading account and then balance sheet, or it could be profit and loss account and balance sheet. Okay, it could be profit and loss account and then balance sheet. So the first effect could either be treated in trading account or profit and loss account. The second treatment has to go into your balance sheet. But never will you come across a scenario where you have adjustment and the adjustment will have to be treated into trading account and profit and loss account. That will not happen. The reason why trading account, profit and loss account, both these are income statements, and then income statements, we will never have an adjustment where we will have to treat the adjustments into twice into your income statements. So the possible combination is trading account and balance sheet, or profit and loss account and then balance sheet. So these are the two possible combinations that you can have when it comes to with respect to adjustments. So this is something that we all have to remember. So to summarize what adjustments are, please remember adjustments are transactions that were identified by the accountant after the preparation of trial balance. Since it has not gone through the routine accounting process, it has been missed out. You will have to treat it twice. The possible combinations are trading account, balance sheet, or profit and loss account and then balance sheet. So these are the possible combinations that you can have with respect to adjustment. Now we will be discussing some of the important adjustments that we will be coming across with respect to preparation of final accounts. The first one that we will be talking about is the closing stock. What is meant by closing stock? Closing stock refers to the value of inventory at the end of the financial year. I repeat that, a closing stock refers to the value of stock at the end of the financial year. So remember, you have your inventory. Inventory is the place where, or your store is the place where you will be stocking your material. So the material you will be consuming constantly. The consumption of raw material is a routine process. You'll be picking up on the raw material, subjecting to some processes, and then it will be converted into finished goods. So that is how we will be going with respect to preparation of or the manufacturing process in an organization. Now, closing stock refers to the value of inventory that you have at the end of the financial year. When it comes to the preparation of final accounts, there are two important values of inventory that we are interested. One is we are interested in the opening stock. Second is we are interested in the value of the closing stock. The difference between these two will help us to understand how much of material has been consumed by the firm during the course of the financial year. Okay? It will help you to understand how much material was consumed during the course of the financial year. So closing stock is the measure of the inventory at the end of the financial year. Okay? It is the measure of the inventory at the end of financial year. So please remember the thumb rule. Any adjustment that you come across, you will have to treat it twice. Okay? Any adjustment that you come across, you will have to treat it twice. So let's talk about the two possible treatments for this adjustment on closing stock. First adjustment is that you will be treating it into your trading account. Okay, so the first treatment is that you will be treating it into your trading account. So trading account, as a part of your trading account format, on the credit side, you already have an item which is called as buy closing stock. You already have an item which is called as the buy closing stock. So this is the first place where you will be treating it. Second place that you will be treating it is into your balance sheet. Okay? The second place where you will be treating the value of closing stock is into your balance sheet. So in the balance sheet, you will be showing this, or you will be treating this on the current asset. Okay? You will be treating closing stock as a current asset. So the first place is trading account, on the credit side as a part of the format that you have already learned. You know that it would be coming on the credit side. Second place that you will be treating it is on the balance sheet. Balance sheet, you will be treating it on the current asset section. You'll be treating it on the current asset section. So these are the two treatments with respect to the closing stock. The next treatment that we would be learning is the depreciation. The next treatment, the next adjustment that we would be learning is depreciation. What is meant by depreciation? Depreciation refers to the reduction in the value of the asset due to wear and tear. Okay, so depreciation refers to the reduction in the value of the asset due to wear and tear. Now, there are certain assets. These assets, they may not be idle, or it may not be fixed in a certain position. You would be utilizing it constantly. So depending on your utilization, what could happen is some of the parts, some of the components of this asset, it could be subjected to wear and tear. So for example, let's say you have a vehicle at home, you have a bike, and you keep using the bike every day. The bike's condition would not remain the same, because it has got certain moving parts. Depending on how you end up using these the machinery, the components of the machinery, it would be subjected to wear and tear. So depreciation refers to the reduction in the value of the asset due to wear and tear. It refers to the reduction in the value of the asset due to wear and tear. So when you come across the term depreciation, how do you go about treating it? The first place that you would be treating depreciation is into your profit and loss account. You would be treating it in your profit and loss account as an indirect expense. So please remember, indirect expenses, it would be featuring on the debit side of your profit and loss account. So you will be treating it as an indirect expense on your profit and loss account on the debit side. Second place that you will be treating is that you will be treating it in your balance sheet. Now, in your balance sheet, on the asset side, you would already be disclosing your fixed assets. On the asset side, you would already be disclosing your fixed assets. So from the fixed asset value, you should be subtracting the value of the depreciation. Okay? So you should be subtracting the value of the depreciation from the value of the fixed asset, which gets disclosed, which gets declared in the balance sheet on the asset side. So from that, you should be subtracting this value of depreciation. So this is how you would be going about treating depreciation. So please remember, depreciation refers to the reduction in the value of the asset due to natural wear and tear. And the first treatment is that you will be treating it into your profit and loss account on the debit side as an indirect expense. Then you will be treating it into your balance sheet as you will be subtracting the value from your balance sheet, and that is how you will be going about treating this particular adjustment. In our discussion about depreciation, there was one more point that I would like to add. When it comes to depreciation, the business can follow different methods of computing depreciation. So there are different methods. So for example, you have annuity method, you have written down method, you have straight line method. So there are different methods that the business can follow when it comes to computation of depreciation. So this has got nothing to do with the method that is followed for computation of depreciation. Here we were discussing, okay, let's say you have decided to calculate the depreciation in your business, in your firm, based on written down value method. Then how to go about treating that decided amount into your books of accounts. So that is what we will be dealing with over here. The next adjustment that we would be discussing is outstanding expenses. Okay. The next adjustment that we are learning is the outstanding expense. What are outstanding expenses? Outstanding expenses are those expenses that are yet to be paid. For some reason, your firm has not settled that expense. They are yet to settle that expense. Such kind of expenses are referred to as outstanding expenses. Outstanding expenses, these are expenses, basically expenses, but they are outstanding right now. They could be outstanding because of a number of reasons. A, you may not have had sufficient amount of money with you right now. You may not have been in a position to pay off, or the person to whom you owe the money, they may have not been available to collect the money. So whatever be the scenario, whatever be the case, in such cases, you would be treating it as, we would be learning how to go about with the treatment. Now, we know that when it comes to preparation of final accounts, there are two kind of expenses. There are two types of expenses that you can have. You have direct expenses, then you have indirect expenses. I'll repeat that. When it comes to outstanding expenses, there are two kinds of expenses that you can have. One is direct expense and the other is indirect expense. If we are dealing with direct expense, please remember all the direct expenses are considered into your trading account. Okay? Direct expenses are considered into your trading account. Uh, when we talk about direct expenses, um, if it's a direct expense which is outstanding, you will have to treat it into your trading account, or a second place that you will be treating is into your balance sheet. In balance sheet, you will be treating this as a current liability. Okay? You will be treating this as a current liability. So if you're talking about outstanding expenses which are direct in nature, first place that you'll be treating is your trading account. Second place that you'll be treating is your balance sheet. Then you have indirect expenses. Now, what are indirect expenses? Indirect expenses are those expenses which are uh, uh, which are for some reason it is indirect in nature, but it is still outstanding. So if you're dealing with indirect outstanding expenses, you'll be treating it in your profit and loss account, and second place that you'll be treating is your balance sheet. So outstanding expenses, we have two subcategories. Is it a direct expense that is outstanding, or is it an indirect expense which is outstanding? If it's direct expense, you will be treating it in your trading account and then balance sheet. If it's an indirect expense that we're talking about, then we'll be dealing in profit and loss account and then balance sheet. So this is the adjustment when it comes to outstanding expenses. The next adjustment that we'll be dealing with is prepaid expenses. What are prepaid expenses? Prepaid expenses are those expenses that are paid in advance. You were anticipating some expenses, but you had sufficient amount of money with you right now, so you decide to pay the money upfront. Such kind of expenses are referred to as prepaid expenses. So let me give you an example. You are paying rent for your premises, and in a specific month you notice that you had excess amount of money with you. Now, instead of holding on to this excess amount of money, you decide to pay your rent off. Okay? So that's a prepaid that's a prepaid expense, and in such cases it becomes prepaid rent for you. Okay? Why? Because you have paid the expense upfront. You have paid the expense well in advance. So any kind of expenses that you pay well in advance, it is referred to as prepaid expenses. Now, prepaid expenses, again, you can have of two types. You have direct. If it's direct, it would be treated in your trading account. And second place that you'll be treating is your balance sheet. Okay, so balance sheet, you'll be showing prepaid expenses uh, as a current asset. Okay, you'll be showing it as a current asset. Now, when it comes to treatment into your trading account, uh, what you have to do over here is you will have to treat it, you will have to subtract it from the main expense. So, for example, wages. You already have an item called as wages, and then you have prepaid wages. So what is prepaid wages? Wages that you have paid in advance. You had some amount of money, you decide to pay your laborers in advance. So that is a prepaid wages for you. So in such cases, what will happen is you will have to take the main wages account amount. From that, you will have to subtract prepaid wages. So let me just quickly explain that to you with an example. So for example, in your business, let's say while preparing wages, while preparing the trading account, you notice that you had wages and the amount was, let's say, 5,000. Okay, and then you also had prepaid wages. So let's say prepaid wages is let's say 300. Okay, so let's say if let's assume that prepaid wages is 300. Okay, so in such cases your net wages amount will become 4,700. Okay, so your net wages amount will become 4,700. Now, had this been outstanding, okay, let's say if you had outstanding wages, then you will have to add. So let's say outstanding wages, let's say you had outstanding wages of 100 rupees, then you will have to add. So in such cases, your net wages will become 800. Okay, so your net wages will become 800. So this is how you'll be going about treating when it comes to direct, uh, direct prepaid wages. Okay, now let's go back to what we were discussing. We were discussing about prepaid expenses. We were talking about direct prepaid expenses. We saw that you will be treating in your trading account, and the second place that you'll be treating is your balance sheet, and then you will be treating it on the you'll be treating it as a current asset. Moving forward, indirect expenses. Now, indirect prepaid expenses, there are two ways that you can do. One is you can subtract it from the expense, just like how I explained for the trading account, or you can show the prepaid expense as an indirect income. Okay? Or you can show it as an indirect income. So there are two ways you can handle this. One is just like how I explained the cases for trading account. Likewise, in profit and loss account, you can subtract it from the main expense, or you can treat it as an indirect income. So this is the first treatment of indirect prepaid expenses. Second treatment is that balance sheet. Balance sheet, you can show it as a current asset. Okay, your balance sheet, you can show it as a current asset. So this is how we will be treating when it comes to prepaid expenses. Okay, this is how we would be carrying on when it comes to prepaid expenses. So this is how we go about with the adjustment of prepaid expenses. The next adjustment that we will be discussing is accrued income. Okay, the next adjustment that we will be learning is accrued income. What is meant by accrued income? Accrued income refers to income earned but not received. Technically, you are entitled to that income, but for some reason, you have not received the payment of that income into your hand. Such kinds of incomes are referred to as accrued income. So let me give you an example. You carried out a transaction, you sold some goods to your customer today. You sold some goods to your customer today, you got a very competitive price. However, the customer does not have money with him right now, and he's promising to pay back the money after 1 month. Okay, he's promising to pay back the money after 1 month. So that is referred to as accrued income. Okay, that income that you have earned in that scenario, in that context, is referred to as accrued income. So income earned but not received. Okay, you have got that income, you are entitled that income, but for some reason you have not received the payment. That is what is referred to as accrued income. Moving on, when it comes to accrued income, you have to treat accrued income just like any regular income. Accrued income, you can treat accrued income just like any other any regular income. So here what happens is you have earned it, but you've not received it. You will be treating this income just like any other income. Okay? You'll be treating it as any other income. Now, when it comes to accrued income, usually we will be talking about only indirect incomes, because the only possible direct income that you can have is sales, and usually you will not be getting that, but you'll be always getting indirect incomes. So how do you go about treating it? The first place that you will be treating is accrued income. You will be treating it in your profit and loss account. You will be treating it as a regular income itself. Since you're treating it as a regular income, it will be reflecting on the right side. Okay, you can treat it under indirect incomes itself. Second place that you will be treating it is that you will be treating it in your balance sheet. Okay, you will be treating in your balance sheet, and you will be treating it as a current asset. Okay, you will be treating in the balance sheet, and you will be treating it as a current asset. So there are two places that you'll be going about with the treatment of accrued income. One is you'll be treating it as an indirect income into your profit and loss account on the right side, and then you'll be treating into your balance sheet. In your balance sheet, you'll be treating it as a current asset. You'll be treating it as a current asset. So these are the two ways by which you'll be going about with the treatment of accrued income. So accrued income, you'll be treating it as a regular income itself. The next adjustment that we would be learning is income received in advance. Okay? The next adjustment that we would be learning is income received in advance. When it comes to income received in advance, this is quite tricky. This adjustment is a very tricky one. The reason being, what is meant by income received in advance? Income received in advance refers to a revenue that is earned by the business even before the delivery of the product or service has taken place. Okay? So it is basically an income that you are receiving in advance even before you have you have delivered the product or you have delivered the service. So let me give you an example. Let's say uh, let's assume that I'm running a bakery. Let us assume that I'm running a bakery, and I got an order for, let's say, a cake, but the cake has to be delivered only after 2 years. Okay, I had a customer. The customer came and placed an order today for some cake, but they want the cake to be delivered only after 2 years. So that is referred to as income received in advance. So I have not delivered the product, I have not rendered the service, but even before that, I have received the income. So income received in advance refers to the income that is earned by the business even before the product, even before the service has been rendered to the customer. So now the challenge with respect to income received in advance is, how do you account for it? Because without rendering the product, without rendering the service, without delivering the product, how will the business go about passing invoices? How can they generate bills? So this becomes a major challenge for the business, because the customer is demanding the product, the customer is demanding the service to be rendered to them at a much later date, but the payment for the product, the payment for the service has already been made by the customer upfront. So in this scenario, the business is not able to generate an invoice. They are not able to generate a bill. Why is that so? Because the product has not been rendered, the product has not been delivered, the service has not been rendered to the customer. So without rendering the service, without delivering the product, how do you generate the invoice? How do you generate the bill? So it's something like this. You bought something from Flipkart, but you're expecting the delivery to take place maybe after 5 years. You bought a computer today, you want Flipkart to deliver the computer for you after 5 years. So how will Flipkart generate a bill? Why? Because the product you are demanding to be delivered only after 5 years. So this is an example, this is a scenario of income received in advance. So the major challenge that the business faces over here is with respect to delivery of the product. Without delivering the product or without rendering the service, they are not able to generate a invoice. Moving forward, how does the business go about treating it? So what the business will do is, business will carry this amount forward until the accounting period of the actual product delivery or actual service rendering. Okay? So until such time, they have to keep carrying this forward. They have to keep pushing this forward. They would have to keep carrying this until such time that until that accounting period where the actual product is rendered, is delivered, and the actual service is given to the customer. So until such time, they will have to keep carrying this forward. So here's how do you go about treating it. You will be treating it in your profit and loss account as an indirect expense. I'll repeat that. You will income received in advance, you will be treating it as an indirect expense. Okay, please remember we are talking about income received in advance, but if at all you come across income received in advance in your final accounts, how you will be treating it? You will be treating it as an indirect expense. I'll repeat that. You'll be treating it as an indirect expense. So why are we treating it as an indirect expense? Because though it is an income, okay, this is income that you're receiving in advance. You have not given the delivery to your customer. You have not rendered the service to your customer, because of which you will have to treat it as an indirect expense. Okay, you will have to treat it as an indirect expense. The second treatment for indirect income is that you will be treating it as a current liability. Okay, you will be treating it as a current liability. So two ways that you go about with the treatment. One is you'll be treating in your profit and loss account as an indirect expense. Second treatment is that you will be treating into your balance sheet as a current liability. Now you have to carry this forward. Okay, this income received in advance, you have to carry this forward until such time, or until the time frame when you are delivering the product or the service. So until such time, you will have to keep showing into your income statement as an indirect expense, in your balance sheet as a current liability. Okay, you have to keep carrying this forward until such